Essprom. EPM Simplified. Close Management and Consolidation. Benefits of using CMC. In this video, we will now discuss about the multi-GAAP in CMC. In general, GAAP stands for Generally Accepted Accounting Principles. GAAP is the commonly accepted accounting rules and standards which is used while preparing financial reports, income statements, and statements of financial position. There are some types of GAAP: local GAAP, which is referred to as country-specific GAAP, where the legal entity operates its business. IFRS, which means International Financial Reporting Standards, is widely accepted as GAAP, which is used by more than 110 countries across the globe. This GAAP was designed by the International Accounting Standards Board. The U.S. GAAP contains accounting rules and standards accepted by the U.S. government for reporting its financial statements, which operates in the U.S. It was designed by the Financial Accounting Standards Board. And also, here you can see the advantages of multi-GAAP in CMC. Single application for multiple standards. No need to create separate applications for different accounting standards. CMC supports multiple GAAPs within the same environment. Streamlined reporting. Enables simultaneous financial reporting under various standards, example, IFRS, US GAAP, and AS, without data duplication. Simplified maintenance. Reduces system complexity and administrative effort since data and mappings are shared across GAAPs. Now, let me show you the multi-GAAP dimension from the CMC instance. The multi-GAAP dimension is an optional dimension that is used if you need to report your financial statements in both local GAAP and an IFRS or other GAAP. This dimension tracks the local GAAP data input as well as any GAAP adjustments. By default, if you select this dimension, the system provides the following dimension members: FCCS_IFRS, FCCS local, GAAP FCCS_adjustments, which you will load your trail balance for the particular entity in local GAAP, and pass the additional adjustments to convert into another GAAP of default IFRS GAAP. Now let's see this clearly with an example is the entity ownership structure. And for this example, we are using New York, 100% holding entity, Chicago 100% subsidiary, and Surabaya 100% subsidiary. Now, as you can see, we have loaded the trail balance for New York under local GAAP and the same for Surabaya and Chicago. Here Global Group reports in IFRS. That is why we have to make adjustments to make it compatible with IFRS. And now, let us see the scenarios where we have made the adjustments to convert this local GAAP into IFRS. We can pass these adjustments as journals and for entities under the USA, that is, New York and Chicago. The local GAAP here is the USA GAAP, and for Surabaya, the local GAAP here is the PSAK, which is called as Pernyataan Standar Akuntansi Keuangan Statements of Financial Accounting Standards for Indonesia. Now let's see the adjustment for USA GAAP to IFRS GAAP if the entity is manufacturing the product, and brought the raw materials and estimated the revenue of the product, but suddenly, the market value of the raw materials and final product fell before the sale of the product. The USA GAAP doesn't care about it. This is under ASC 330 and IAS 2, as it only cares about the price at which the product is sold after purchasing the raw materials, but the IFRS will allow the adjustments as per the market value of the product, even before the sale of the product. So you can see the adjustments for New York at the account raw materials net and also COGS. Same in the case of Chicago. This is under ASC 330 and IAS 2. As it only cares about the price at which the product is sold after purchasing the raw materials, but the IFRS will allow the adjustments as per the market value of the product, even before the sale of the product, so you can see the adjustments for New York at the account raw materials net and also COGS, and considering the long-term debt and short-term debt if the entity has taken a short-term debt with a time period below 12 months and the reclassified portion of the loan due within 12 months. Refinanced under US GAAP but remains short-term under IFRS. So, for New York and Chicago, you can see these adjustments of IFRS, which do not consider the short-term debt transfers to long-term debt. Under IAS 1 and ASC 470. In the case of Surabaya, which follows the PSAK GAAP, this entity, if we consider the revenue, we could recognize revenue when an order is received in PSAK 23, but only when the customer receives the order in IFRS 15. So you can see that particular adjustment was made at the income statement accounts for food rep breakfast COGS food ingredients. We can see all the accounts and their adjustment passed to convert into IFRS on an entity-wise basis in this web form. This is for entity New York, and this is for entity Chicago, and this is for entity Surabaya. Now, let us run the consolidation rule. Now we can see the data has rolled up to the global group in this web form, where we can see the global group consolidated with both IFRS and local GAAP. Let me now take you to the dashboard as the dashboard, where we can see the multi-GAAP adjustments by entity clearly. For more details, mail us at support@essprom.com.